Canada just shipped its first liquefied natural gas to Asia. That's not a milestone, that's a declaration of energy independence from the United States. And it represents the beginning of a 50 million ton annual export strategy that permanently breaks America's monopoly on Canadian energy. Here's what's actually happening. LNG Canada facility in Kitimat, British Columbia shipped its first cargo to South Korea in July 2025. 14 million tons per year capacity operational. 6 additional LNG facilities under construction or planned. Combined capacity reaching 50 million tons annually by 2030. All of it destined for the Asian markets, none of it flowing to the United States. But Carney didn't stop with liquefied natural gas. He's restructuring Canada's entire energy export model. Trans Mountain pipeline expansion tripled oil export capacity to Asian markets, 890,000 barrels per day flowing west to Pacific ports. China, India, Japan, South Korea buying Canadian crude that used to go exclusively to American refineries. Natural gas exports to Asia, replacing pipeline sales to the United States. Critical minerals partnerships with Malaysia, Indonesia, Japan for battery supply chains and clean energy technology. This isn't theory. Canada's energy minister just returned from India declaring huge demand for new LNG and real opportunity for Canada to play a more significant role. Carney visited China and signed energy cooperation agreements. Malaysia, South Korea, Japan are investing in Canadian LNG infrastructure as equity partners. The Asian energy pivot that seemed theoretical 2 years ago is now operational with billions in capital deployed and first shipments delivered. Today, we're showing you how Canada went from exporting 89% of energy to the United States to building a 50 million ton Asian export machine. How Carney turned Trump's tariff threats into justification for permanent trade diversification. How Canadian LNG is replacing Russian gas in Europe and coal-fired power in Asia simultaneously, and why this energy transformation makes reversing back to American independence mathematically impossible. But before we dive into this story, if you appreciate in-depth analysis like this, hit that like button and subscribe to stay informed on the stories that truly matter. Let's start with what actually shipped. July 2025, LNG Canada's facility in Kitimat, British Columbia produced its first liquefied natural gas shipment for export. Destination, South Korea. Capacity, 14 million tons per year from 2 operational trains. The $18 billion facility represents the largest private sector investment in Canadian history. Ownership split between Shell at 40%, Malaysia's Petronas at the 25%, PetroChina at 15%, Mitsubishi Corporation of Japan at 15%, and South Korea's KOGAS at 5%. The Asian equity partners aren't customers. They're co-owners, guaranteeing long-term offtake. Carney's response wasn't to celebrate one facility. It was to accelerate 6 more. Ksi Lisims LNG, 12 million tons per year capacity, targeted startup in 2028, backed by Nisga'a Nation and Blackstone. Woodfibre LNG, 2.1 million tons annually, expected online by 2028. Cedar LNG, 3 million tons per year, targeting 2028 completion, plus 3 additional projects in various approval stages. Combined capacity approaching 50 million tons annually by decade's end. But Carney didn't stop there. He restructured the entire approval process, created the Major Projects Office to fast-track LNG infrastructure. Ksi Lisims referred to the office for expedited review within 2 months of receiving provincial and federal environmental approvals. The North Coast Transmission Line got a $139.5 million loan from Canada Infrastructure Bank to support initial work. The Prince Rupert Gas Transmission Pipeline received federal coordination for timely approvals, environmental assessment exemptions for critical electricity infrastructure serving LNG facilities. The Asian partnerships went deeper. Malaysia, letter of intent signed in October 2025, covering LNG, oil, small modular reactors, and renewables. China, energy cooperation agreement in January 2026, focusing on LNG supply, clean technology, and climate competitiveness. India, Energy Minister Tim Hodgson just returned declaring huge demand for new LNG. And Canada targeting 15% of India's energy mix conversion from coal. South Korea, Industrial Collaboration Memorandum, strengthening Canada-Korea cooperation for future mobility and energy. The mathematical result is simple. Canadian natural gas that used to flow exclusively south through pipelines to American markets is being liquefied and shipped west to Asian buyers at higher prices with long-term contracts. The infrastructure being built locks in Pacific export orientation. The equity partnerships with Asian companies create permanent commercial relationships. And the regulatory framework prioritizes LNG exports as nation-building projects worthy of expedited approval. Here's where it gets fascinating. The natural gas that used to sell to American buyers through pipelines at Alberta, AECO benchmark pricing, is now being liquefied and shipped to Asian markets at significantly higher netbacks. AECO pricing averaged $1.36 per million BTU in 2024. Expected to rise to $2.20 in second half of 2025, projected $3.50 by 2026. But Asian LNG spot prices trade at multiples of North American pipeline gas. The liquefaction costs and shipping expenses are offset by the premium Asian buyers pay for energy security and coal displacement. Those LNG facilities have to generate returns for equity investors. The Asian partners who funded construction expect profits, which means Canadian gas producers can charge higher wellhead prices because LNG facilities will pay premiums to secure long-term supply. So Canadian natural gas prices are rising from historic lows toward levels that make production economics work even in higher cost formations. The export market is pulling prices up, and the captive buyers are Asian utilities that sign 20-year offtake agreements. This creates a fascinating dynamic. Canadian energy companies that used to depend entirely on American pipeline access are now building production specifically for LNG export. New drilling in the Montney Basin targeting gas volumes for liquefaction. Production growth from 1.4 million barrels of oil equivalent per day in 2019, projected to reach 1.6 million by 2025, and climbing further as LNG facilities ramp up. The investment that used to flow toward oil sands and conventional crude is being redirected toward natural gas production for export liquefaction. Meanwhile, American energy markets are losing the Canadian gas that used to flow south. Pipeline exports to the United States peaked around 8 billion cubic feet per day in 2007, dropped significantly as American shale production exploded, now facing further declines as Canadian production gets redirected to LNG facilities on the Pacific coast. The 6 billion cubic feet per day of incremental gas demand from operational and planned LNG projects by decade's end represents gas that won't be available for American export pipelines. The energy industry keeps claiming Canadian gas will continue serving both American pipelines and Asian LNG markets. They're lying, or they're hoping nobody notices that production growth projections don't support simultaneous increases in pipeline exports and LNG shipments. Canadian gas production can grow, but not fast enough to supply existing American contracts, new LNG facilities, and domestic Canadian demand simultaneously. Something has to give, and it's going to be the American pipeline volumes that never had long-term contracts or equity partnerships backing them. While Canadian LNG infrastructure builds Pacific export capacity, Carney is executing an energy pivot that doesn't include American market dependence. Energy Minister Tim Hodgson visited India in late January 2026, met with Indian counterparts about natural gas expansion from 6% of India's energy mix to 15%, discussed Canadian LNG playing a more significant role in India's coal-to-gas transition. India represents one of the most important energy markets in the world, with demand growth that dwarfs anything in mature American markets. Carney visited China in January 2026, met with President Xi Jinping, agreed to energy cooperation focused on LNG supply, clean technology, and climate competitiveness. China announced plans to double its electricity grid over the next 15 years. That grid expansion requires massive natural gas imports for baseload power, while renewables scale up. Canadian LNG positioned as reliable, lower carbon alternative to coal and Russian pipeline gas. Malaysia signed a letter of intent with Canada in October 2025, covering LNG, oil, small modular reactors, and renewables. Malaysia's state energy firm Petronas is already a 25% equity partner in LNG Canada. The partnership is expanding beyond single project investment toward comprehensive energy technology cooperation. Canada supplying LNG, Malaysia providing expertise in tropical LNG operations and Asian market access. The human cost of this energy transformation falls on nobody. This isn't economic restructuring that destroys jobs. This is capacity expansion that creates them. LNG facilities require construction workers, operations personnel, maintenance technicians. Pipeline construction employs thousands. Gas production growth drives drilling activity and service sector demand. British Columbia estimates 96,000 jobs annually over project life cycles from LNG development. Alberta sees increased drilling and production activity. Federal government collects royalties and corporate taxes from energy sector growth. But here's the strategic calculation Carney made. Energy exports to the United States are vulnerable to American tariffs, pipeline politics, and regulatory uncertainty. Energy exports to Asia via LNG are protected by long-term contracts, equity partnerships with Asian state energy companies, and marine shipping that doesn't depend on cross-border pipeline approvals. Better to invest in Pacific infrastructure with guaranteed offtake than remain dependent on American market access that Trump threatens to weaponize. While American tariffs threaten Canadian energy exports through pipelines, Canadian LNG facilities that survive construction delays and environmental opposition are being positioned better than they've been in decades. The first shipment to South Korea in July 2025 validated the business model. Asian buyers are paying premiums for Canadian gas. The shorter Pacific shipping routes compared to American Gulf Coast LNG give Canada competitive advantages. And the Asia-Pacific market is growing while American demand stagnates. The endgame is clear. Canada becomes Asia's primary North American LNG supplier, not because American LNG disappeared, but because Canadian infrastructure was built specifically for Asian markets, while American facilities focus on Atlantic and European customers. 50 million tons annual export capacity by 2030. Long-term contracts with Chinese, Japanese, Korean, Indian buyers. Equity partnerships with Asian state energy companies guaranteeing offtake. Pacific shipping routes that avoid Panama Canal congestion and provide faster delivery to Asian destinations than Gulf Coast American LNG. American pipeline dependence doesn't get reduced gradually. It gets broken permanently. Because Canadian energy companies that used to negotiate pipeline access with American regulators are now negotiating LNG offtake with Asian utilities. The commercial relationships are shifting, the infrastructure is being built, and the regulatory environment prioritizes export facilities over pipeline expansions. Canadian energy workers see massive job growth, not from replacing one export market with another, from adding Asian LNG exports on top of continuing North American pipeline sales. The production growth required to feed 6 billion cubic feet per day of new LNG demand creates drilling activity. The facility construction employs tens of thousands. The operations and maintenance generates permanent employment. Communities near LNG facilities get infrastructure investments, tax revenues, and economic development that persists for decades. Canada, meanwhile, builds an energy export architecture that serves Asian energy security first, European gas diversification away from Russia second, and views American pipeline markets as residual demand that gets supplied if production permits, but doesn't drive investment decisions or infrastructure planning. 50 million tons annually isn't just responding to Asian energy demand, it's restructuring Canadian energy for a post-American export model. And that restructuring is permanent. LNG facilities don't get decommissioned when American administrations change. Offtake contracts don't expire when tariff threats end. Equity partnerships with Asian state firms don't reverse when presidents shift. Pacific shipping infrastructure doesn't close. Trump thought threatening Canadian energy with tariffs would pressure Carney into submission. He permanently redirected Canadian energy toward Asia. He made Canadian LNG capacity massive, Asian-focused, and American-independent. He made Asian energy partnerships deep, equity-backed, and long-term contracted. Canada paid short-term cost, $18 billion for LNG Canada. Additional billions for 5 more facilities. Infrastructure investments that took years to permit and construct. But Canada is emerging as Asia's energy partner, Europe's Russian gas alternative, and permanently positioned to export energy without American permission. America paid no short-term costs, but the long-term cost is Canadian energy that used to flow south now flowing west. Canadian natural gas, that used to fill American pipelines, now filling Asian LNG tankers. A Canada that builds 50 million tons of Pacific export capacity, specifically to avoid dependence on American markets. Canada wins, Trump loses, and the North American energy relationship transforms from integration to competition.